Okay, Tom, welcome. Let's do this. I've been excited for this for a very long time
It's
and hope you're ready.
yeah, no, always ready. Great to see you, and look forward to the conversation.
All right, let's dive in right with something that's kind of fresh off the press, the Nebius Inflection event.
Yeah,
Um, I have a lot of subscribers on X who are very interested in this event and who want to know what's going on. Is this just a PR event? What was new? And I sadly I couldn't make it myself, obviously. So I'm actually equally curious. Could you maybe give us a quick summary of like what are the major announcements you made? And
yeah,
can you give us like the quick digest of it? Like what's the real news?
yeah. Well, one announcement we made was that it will be a regular event, so we'll make sure that
Yeah.
we'll see you at the next one. But no, for us actually, what we did. So this was in San Francisco yesterday. We had Arkady, Roma, Andrei, Mark, and so on, and the rest of the management team, Ophir. But it was not so much a news event, but rather we felt it was important. We've never done something of this scale before, where we've really brought everyone together to sort of start talking about the business, the industry, how we see it, and where we believe it's going. It's. I think we generally sometimes have a sense that this is an industry that's very new. It's moving very quickly, lots of different labels, lots of different categories, and it's one that actually we felt that there would be value in having more of a deep dive into where things are, where they're going, what we have, what we don't, what the aspirations are, and so on. And we accordingly assembled a broad group of our stakeholders, from investors to media to a lot of our customers, a lot of the industry, and so on. So we felt it was good. We felt it was well received, and there was a lot of actual. It wasn't just us talking, but a lot of discussion, actually feedback. We had sort of sessions with customers where we were kind of talking about, hey, what doesn't work, what can we do better, and so on. So we think it went well, and we'll do it again.
Awesome. And this is something you will do globally. I assume there will be an event, maybe Berlin, London, Paris. I guess London.
I'll be honest. We actually, when we first set out, we actually did have an idea to just take it on the road and follow up in London, maybe Singapore, maybe somewhere else, and we just sort of slightly ran out of steam at the end. So we decided to focus on making sure San Francisco went well. But in the future, I think it's the kind of thing that we will be able to, that we will roll out and do globally. San Francisco to this day continues. If you're going to start somewhere, that's really where you have a
Yeah,
heavy
for sure.
concentration of the industry. But as London's important to us. We're going to be building out in Asia as well. So, it's certainly something that has global relevance.
All right. Then the next thing I would love to get your take on is I think it was was it in the last earnings call where Nebius announced that you're increasing CapEx to 20 to 25 billion
Mhm.
this year already? And if I remember correctly, the reason given was that you already have very strong demand visibility into 2027.
Mhm.
So now I'm curious, what does that actually mean? Does it mean signed contract, very advanced negotiations, already reserved capacity? How, what can you share about what strong demand visibility means?
Yeah, so I mean, I think the answer to your question is a combination. I mean, we do certainly have a fair amount of contracted capacity that goes well into 27 and the years beyond. But it's not just that. It's not like we just have a few big customers that are waiting for it. But it's what we're seeing. And I think Mark also spoke about this, that with every GPU that comes online, there's probably 4x plus demand. And so from a combination of what we do actually have contracted over a longer term, but also just the incredibly strong demand dynamics that we're seeing across the board, from the startup to the enterprise and so on, we feel that and again, the additional capex is going into more capacity that's going to be coming on stream in 27 and so on.
Mhm.
We feel extremely comfortable that there's no question of whether we'll sell. It's like everything that we're seeing up
Yeah,
now, everything we bring online is usually already sold. And so we think it
yeah.
makes sense for us, where we can go faster, to go faster in bringing on capacity for the future.
Does it make sense to actually see selling capacity as a risk, as stupid as it sounds? Because when you sell capacity, obviously, I know I've actually discussed this with Mark, and he also probably talked about this very, very well in details, that the way some of the deals you've structured are insanely smart. And to be frank, I don't understand how a small company like Nebius gets so much leverage in these deals, where basically companies like big hyperscalers give you like downside protection, and you have the right to sell at higher prices. So it's like you get the upside potential with the downside risk cap, which is ridiculously good terms. But assuming not all deals will be like that, is it fair to assume that actually selling capacity is a risk because you miss out on spot prices going to the moon, which has happened over the last couple of months? And personally, I believe I think agentic AI hasn't started, because the things that agents can do end to end for me is very, very limited. I'm insanely impressed and simultaneously think it will get ridiculously better. So so it was a long question, but do you get the question? Like, is selling a risk here? Is selling a risk?
It's a long question, but it's a great question, and it's something that we think about a lot. I would say that, okay, maybe you wouldn't describe selling capacity as a risk per se, but does it, if you were to put too much into the long-term sort of capacity, up front, do you remove, the potential to be selling at higher prices and higher margins in the shorter term market? The answer is yes, which is why, we think very carefully about what the balance is between a big Microsoft or a big Meta contract versus having capacity, shorter term capacity that we can be selling into the sort of the shorter term market, where, generally speaking, some of the, the prices can be higher that you can achieve there. So, I think that this is something that, Arkady spoken about, Ophir spoken about a little bit on our earnings calls, but, we view these long-term contracts. I mean, the terms of these long-term contracts are attractive in their own right, and we can come back onto that. I mean, we always maintain a clear view of the types of margins we want to be achieving in the short term and long term, and we make sure we don't compromise that even on these big.
Have you shared how profitable these bare metal contracts are on their own?
We haven't gone into the specifics, but what we've said is that they're in line with the sort of the general kind of trajectory that we've spoken about. However, the internal debate that we have, and it's an ongoing one, is what's the right share? Because we know that there's limitless, demand on these big mega types of contracts, but at the same time, that's not the business that we're building over the long term. The business that we're building over the long term is serving the long tail of everybody else. So the hundreds, thousands, the tens of thousands of customers, from everything from a sort of small researcher startup to a scale up and a large enterprise. That's, for us, that's the future, and that's the real business that we're building. And at the same time, we know this is a very capital intensive industry, and we want to be really smart about how we're financing the build out. And by smart, I mean financing it efficiently, effectively and efficiently, so that we're not taking on massive amounts of debt. We're minimizing dilution, and we're finding cost-effective ways to finance the build-out. So that inevitably means a balancing out between some of these longer-term gigs, but while making sure that we retain a sufficient capacity to be not only just selling into the shorter-term market, but selling into what we believe is really the future market opportunity that we're building for.
Actually, that's something where I'm not an expert at all, but I know this is a very big debate. So my very simplistic view is like, I like the idea of being long compute, being short fiat, being short USD. Can you maybe explain why it might not be a good? I mean, the obvious name, the elephant in the room here would be CoreWeave, where a lot of people on X. I have no opinion, just by the way. I have no opinion. I don't know if this is right or wrong. But a lot of people say like, oh, CoreWeave has like toxic financing, etc. To me, the idea of going maximum USD debt and go long compute sounds like a perfect trade, to be honest. Can you maybe explain why you're so careful about this? And are there some risks what are the risks that why you want to avoid this, basically?
Look, you have lots of different companies in our industry, lots of different business models, and lots of arguments behind the different models that might exist, within the broader industry. But when we're speaking about Nebius, I think that for us, I mean, we have a natural sort of view. We don't like the idea of having, excessively high levels of debts. We just don't think that's a sort of a sensible way of financing and building. We try to be very kind of sensitive about dilution, and at the same time, we have a real focus on margins. Now, there could be a view that you just focus on revenue, revenue first, do anything you can to build up the revenue. That's not really the view that we have. We think that actually this ultimately is better as a business that can also be generating healthy returns, healthy margins. And so for us, having the model that we have, which is going out and servicing a really diverse range of customers, yes, some of the big ones, but a lot of the small ones and everything in between, and being able to have more flexibility around pricing and so on, and not only being locked up in these quite very, very long-term contracts, we believe that's the best model that ultimately is going to make for the most sustainable business, a business that's going to go into many years in the future, and that it gives us flexibility while being sensible on debt and sensible on dilution and so on. So that's how we see it. And again, ultimately, will there still be massive demand from big hyperscalers in 5 years' time, 7 years' time? Not sure, actually, but we're very sure that
Uh-huh.
there's going to be demand if you're able to, and your platform allows you to service the
Uh-huh.
thousands and tens of thousands of customers. We know the demand is going to be increasing there, and we want to make sure that we have a platform and product that allows us to service that broad range and not just a handful.
Gotcha. You mentioned this is a big conversation internally,
Yeah.
and rightfully so. I think there's just I think this is going to continue to be discussion internally because there just is no objective answer, right? But as of right now, can you give us like some rough numbers of like what kind of split between hyperscalers, frontier labs, enterprise customers you're kind of
Yeah.
targeting, or like, like you know what I mean? Like, because obviously you approach it strategically and not just based on demand. Based on
Yeah.
demand, I have no idea. Maybe that would be like 90% hyperscalers, but based on how you steer, like what kind of split do you feel like is your target right now?
Yeah, so there's different ways of thinking about it in terms of what we would consider optimal and where we see this going. To give you the sort of simple part of the answer to your question, if you look at our 26 ARR guidance, and if you look at some of the big contracts that we have versus the shorter term, we're probably going to be something like 50-50 from an ARR
Uh-huh.
on 26 for the big long term versus the other. And is that going to remain the same for the next, sort of 2-3 years? I mean, honestly, it's a bit, it's hard to say, and we don't have a specific idea of, sort of, this is the right split between this and that. There are a lot of different considerations that go into it. But, coming back to what we started with, yesterday, our inception event in San Francisco. I mean, Arkady spent some time laying out the sort of the mid to long term vision in terms of how we think about the future and building. And what he walked through, our like CapEx sort of idea, or ultimately the amount of money that we believe will ultimately be required in the long term to have a business that's, one of the top cloud companies in the world that's operating at a
Uh-huh.
serious technological level, but also a serious scale level. And, he said this is a kind of, he had a 200 billion number on a slide, and that wasn't tied to a particular time frame, but it's just like this ultimately isn't a tens of billions of game. This is the hundreds of
Uh-huh.
billions, ultimately. And so how do you finance that if you want to continue to maintain this principle of financing efficiently? You've got to look
Uh-huh.
at all different sources, and definitely the hyperscaler, the kind of meta type agreements will play an important role in allowing us to continue.
Uh-huh.
Again, if you come back to Meta, what we ultimately achieved with that is that not only is it a big contract in its own right, but there's a lot of capacity that's effectively underwritten that allows us to go out and borrow against that at the kind of credit ratings that would otherwise be unattainable to us against this type of contract. So we want to be smart. And that
Uh-huh.
will inevitably involve a continued combination between the two. But it's an ongoing internal debate as to what's the right amount, because we know that anything we give to the Mark and the cloud business, it will get sold. We know that there's endless demand from the big guys. And so we just need to, find the best sort of formula based on opportunities, based on, capacity opportunities that we have and so on. So there's no single answer. But I think that if you look at it from a dynamic or trend standpoint, the further we go, the more the shift is going to go into the long tail rather than the kind of the big contracts, and that will be the direction that we're going.
Yeah. Yeah. Man, I have to. I have so many follow-up questions, but I think we're gonna move on. Maybe one last question to kind of follow up on this is, when you say the big guys, does that include hyperscalers, or do you also put the Frontier Labs, OpenAI, and Anthropic into that bucket? Because you've probably seen an X that I'm like, from my point of view, there's so many connections you guys have with Anthropic. First of all, Anthropic seems like they're actually compute starved. Like I hit the limits every day. I feel like if I just look at Claude, it's out of tokens. It's like I just open the tab and I intuitively already think I'm going to get the limit again. Coding is getting ridiculously expensive. It's getting so good and so expensive, which is obviously a luxury problem to have, right? Because it's so expensive, because I want to use it more.
Yeah.
But it's also getting slow. The latency is starting to really, really annoy me. The user experience is getting very, very bad from my point of view. But then, of course, you have other issues like, I mean, you mentioned the credit rating. Obviously, with OpenAI and Oracle, the credit rating has been a big thing. But then there have been public tweets. For example, Roman has made, like, I don't know, like half a year ago, he was like, hey, at Sam Altman, like, if you need compute, we could help. So can you help me how me and other investors should think about potential deals with Anthropic, OpenAI? The demand from their side is obviously like crazy. They already work with CoreWeave. Like indirectly, I feel like Roman has kind of teased that potentially happening, because he said all of the big ones want to diversify their providers. But at the same time, the credit rating, of course, speaks against working with them. But then your 200 billion growth ambitions are again like, you need somebody that makes these massive commitments. And OpenAI said they want to get to like 30 gigawatts by 2030. That's not that long into the future. And if you think about this being like 30 nuclear power plants, like, goddamn. So yeah, I'm just gonna dump all of that on you, and like, happy to get any insights you can deliver.
Well, look, I mean, I think, first of all, there are multiple ways that, you can be working with different organizations, from an Anthropic or OpenAI or Microsoft or Meta and so on. It's not all about capacity. There can be different. So there are a lot of different, I think it's fair to say that we're all in touch with everyone, and there are a lot of different conversations that are had at different times about different topics, not only just about who buys compute where. And at the end of the day, we consider a wide variety of, of issues or questions when we're thinking about which deal makes the most sense, from the simple economics of the deal, but also the credit, the implied credit ratings around it, in terms of further borrowing, as well as financing needs, as well as, where there's, so there's a lot that goes into any one of these sort of deals that we'll think about. And so, we're very proud of the relationship with Microsoft and Meta. It's a great. We consider these to be, important relationships. So there's a lot of trust between our teams. But do we speak to everyone? Yes, and we consider lots of different factors when we think about how we allocate capacity.
All right, yeah, that's gonna be it's gonna be great cinema to see kind of who gets it. It's also funny that everybody here seems to have like this co-opetition where like XAI, where Elon called Anthropic misanthropic. A few months later, boom, they're making a deal. And then Cursor, I think, trains, and not sure if they only train or also run models on Nebius, but they definitely use Nebius.
Mm-hmm.
And now Cursor has potentially gets bought out by SpaceX.
Yeah.
Which like this, and Colossus might like. Can you also maybe help me understand like the co-opetition in this industry? It seems to be like ridiculous. People go from insulting each other to working with each other. Like, and obviously there's all this human drama. Like, how do you think about this co-opetition nature in the industry? It's very interesting, but also very confusing, to be honest.
Well, I like to think that we ourselves maintain a degree of humility. We're humble in how we operate, how we talk about others. I don't think we insult anyone else. And at the same time, we're open to all different types of conversations. But I think what's important to understand is that when we think about, again, the, demand coming from the, the large tech, we look at that through a slightly more narrow lens of, is this going to be an efficient way of us financing the core business? And ultimately, where do we really put our energy? Where do we really put our kind of future thinking? It's around everybody else, right? I mean, now, because as a client, as you mentioned, they've become a really, they're major, it's already a large tech company, you could almost say, but it's the everyone outside of the kind of the big tech world that we think is the future. And that's where I think where we put most of our energy into making sure that we're really building a software stack for the future that's going to be relevant to, and again, I think, most of the growth is going to come from the enterprise world in the coming years, right?
Yeah, for sure.
So, and so laser focus there in making sure that we're doing everything that we can to be in a position to really, win in that space. That's strategic objective number one. Every other consideration is about what helps us get there. And I think, one of the things that Arkady said yesterday in San Francisco, we feel that there's really a relatively small number of companies in the in the world, in the Western world, that have the technology as well as the scale to really be able to build for the future. And we consider ourselves to be in a relatively small camp. You can debate, is that 5 companies, 6 companies, 4 companies? You can have that debate, but it's not a huge number of companies. We don't believe it will be huge, and we see ourselves being very much in the top league there.
Yeah, totally. Okay, let's go back to some of the more, in Germany, I would say nüchtern, some of the more maybe boring, less dramatic parts of the business. So when we talk about ARR, this is obviously a product. If you have it simplified, it's obviously a product of how much capacity you have online times how much money do you make per capacity, basically. Now, if you look at capacity online, or like how many megawatts do you have online and how much revenue do you make per megawatt, which of the two variables in general do you think is more risky and more volatile? So, for example, with capacity, do you think there's a big chance that you might get 30% more capacity over your target, or is it something you can quite accurately plan against based on how much capital and timelines, and you diversify a bit? And same for like the dollars per megawatt you can charge. Is this also kind of locked in because you have this long-term locked in contracts, or are you increasingly going to be exposed to spot prices? So with these two variables, how much kind of upside potential do you see in both of them? And how much risk do you see in misses, let's say based on data center delays or stuff like that, or having to use alternative power solutions that might be great, but like slightly more expensive? Like, how do you see the risks and upside for capacity and monetization of capacity?
Yeah, it's a good question. I mean, so I think that one of the things that you have seen, if you look at the last few quarters, is that we have been sort of consistently outperforming and raising capacity guidance around our contracted power. And so as we on the last earnings call, we said that we're already at 3 gigawatts of contracted power. We increased the 26 target to more than 4 gigawatts. Now, when we talk about, so contracted power means we have the land and we have the commitment around the power and so on. But actually, and we believe that really doubling down on the contracted power is a very smart thing for the future. Now, and so when we think about, if you look at sort of total CapEx, as again, this is something we've referred to a little bit on a couple of the recent earnings calls, but the contracted power kind of gets us to maybe, let's say 1-2% of the total CapEx. And so, we think that contracted power is really building for the future. So this is kind of, 27, 28 and beyond. And we think it really makes sense to be going as fast as we can. When we first started, again, we made big strides in terms of building up the contracted power base, because that's ultimately your growth for the future. But it's reasonably well protected and de-risked growth for the future, because again, the contracted power, it's a relatively small percentage. Building out into actually constructed power, where you have the data centers that are there, that takes you to maybe 20% of the CapEx. And then the remaining 80% is when you come in with the GPUs and so on. And so you can actually really create this kind of let's say platform that can help you to really accelerate growth around clear side of demand, right? So
Uh-huh.
I would say, so we feel that it's a smart way to invest and to create a platform that allows us to potentially go after more aggressive growth in the future, but without having to, while limiting your CapEx effectively and being able to do the more significant part of the CapEx around clear-sided demand. So I would say that, when it comes to that sort of capacity, a lot of these bigger projects that we've been able to secure, be it around Independence or Pennsylvania, that's all capacity that's going to be starting to come online in 27 and beyond. So I think that's a big part of our focus. 26 is we are where we are in 26. We feel comfortable with everything that we've put out in terms of our ability to deliver. But I think that when we come to the upside and the kind of the bigger upside that's coming around these multiple gigawatts, this is obviously 27, 28 and beyond.
Yeah. And I think the one big number that you dropped was, correct me if I'm wrong, I think 5 gigawatts of deployed capacity of NVIDIA systems by 2030. Now, one thing that to me is a little ambiguous in that wording is, does that mean minimum 5 gigawatt? Does it mean target of 5 gigawatt? And does it mean NVIDIA only? So how can we think of this as your target? Should we think of this as like your NVIDIA specific target? For example, you might work with, I don't know, Grok, Cerebra, Sambonova, whatever's. I mean, AI moves quickly, right? So there might be crazy stuff coming up in the next 3.5 years, which in the age of singularity might be a couple of decades. So like how should we think of this 5 gigawatt number? Target, like a stretch goal,
Yeah.
or like bottom line, or like.
It's a good question. I think that the key is really what you ended up with, which is that AI moves very quickly. We're moving very quickly, and I think we've quite consciously not been very granular in terms of numbers that go beyond 26 at this stage, because the reality is that if someone had asked us 18 months ago where we were going to be today, we're probably well ahead of that, and and I think maybe in another 18 months time. We will be again. So I think that there's a reason that actually, the more granular guidance is around 26, and beyond that, it's much less specific. Just because I don't think we want to be tying ourselves to very specific numbers for 2, 3, 4 years time, because actually we don't know exactly. But what we do see, the trend seems to be, the more we do, the better it is. So I wouldn't see it as a minimum maximum, but it's part of our thinking for how we're building for the future.
Okay, so it's like a direction.
I think a direction is fair, and we think that that we will get more granular as we go in terms of future years. At the moment, there's just a really big focus on making sure that we create as much opportunity for us to be sort of aggressively growing and going after opportunities in the years to come, and in a way, if you have the power and the land, then the rest you can actually, it's in your hands to some degree in terms of the timeline beyond that. We're good at building fast. We're good at bringing capacity online, quickly. But whereas, if you don't have the power and land, then that's a potential bottleneck. And so unlocking that bottleneck for the future, we think makes a lot of sense. And then, as we see demand growing or as we see specific opportunities, we can then try and accelerate beyond that.
Yeah. Okay. So last question, monetization of capacity, specifically tied to NVIDIA again, is, I think when it comes to dollars, you can charge per megawatt or $1 million per megawatt per year. I don't know why, but for whatever, maybe because it's a flat number. A lot of investors just generally always assume 10 million per megawatt. But with new NVIDIA chip generations coming online, you feel dynamics, you have the newer chips, which of course cost more, but also will be more efficient. I think Jensen loves to talk about total cost of ownership, or basically like tokens per watt. Like make the holistic calculation, right? It's not just one variable. It's like how much do you pay overall and how much do you get overall, or essentially you can say a cost per intelligence. And with these newer chips, some estimates I've seen them go up to 50 million or even 20 million per megawatt. Can you help me understand like how to think about that? Because I don't know why people always come up with this 10 million per megawatt number. Like, is there? I know this is a very complicated question because there's many variables, but can you say anything about maybe how to think about that?
So we haven't given specific, kind of revenue per megawatt numbers at point. And, I think that, partly this is a dynamic market. There are also there are competitive considerations where it's not necessarily advantageous to get too specific around particular kind of, prices, margins around particular contracts and so on. So that's a kind of number we haven't given it. But as I say, but it's also just because, this is industry moving quickly. The pricing environment is moving quickly. And so, I think that as we go forward, we'll probably, be thinking about it, sort of additional kind of metrics that we'll be kind of bringing in and sort of reporting on an ongoing basis. But I think that what we can say and what we have definitely, and I think is important to understand is that first of all, this is where I think our sort of full stack approach comes into it, which is that when we, build from ground up and we control all layers of the stack, that gives us, first of all, it gives us better margins. We have better control of the economics. Our ultimate, that the TCO or total cost of ownership can be lower in our case than, let's say, than is the average in our industry. And I think that's really important. And it's something that, we will continue to build in that way. And actually, again, coming back to yesterday, Arkady on one of his slides showed that when we're looking at this future capacity coming online, about 75% of that will be our owned capacity, where we will own everything. And we think that's important. It's an important differentiator, and it's something more akin, let's say, to the hyperscalers in terms of the capacity that they have. So we will, we're going to remain very focused on margins. We want to make sure that we're building efficiently, that having the kind of the lower sort of cost of ownership is important for us. And by having all of the layers of the stack, that's something that allows us to achieve that. And where does agentic go, and what will be the pricing of different layers of stack in the future? Honestly, we don't really know, and so we try to sort of make sure that the numbers we're putting out are grounded based on what we see now, and where things are in the future. We'll see, but we feel good about the trajectory and our ability to maintain that trajectory.
When it comes to site specific announcement, when you announce a new site, what is the milestone you're waiting for there? Is it like when you have to contract power? Is when you start kind of shovels in the ground, when the first charge, like how do you think about what's the right moment to announce a site? It's obviously very data specific, but like
yeah, that's a good question, and I would say that there can sometimes be in the discussions about what's the most sort of helpful from a kind of a market communication standpoint. So if it's something that's it's a small incremental, you might feel less of a. It might just be more helpful to bundle that into something broader. You say we'll cover this at earnings. If it's a bigger one, then the argument would be that that's actually more material. So you shouldn't just sort of wait and you want to do it. But I think that again, there isn't a hard and fast one on this. This is not it's not a very clearly defined, when exactly sites should be announced at what stage and so on. So what our principle is that we want to make sure that, we have a sufficiently high level of comfort that we have everything in place, that what we announce, we're going to execute on. And so, from the point of view of making sure that we feel comfortable with, the contracted power, the permits and so on, that, so usually when we come to an announcement, number one, it means that we've sufficiently due diligence this to have a very high level of confidence in our ability to execute, so that, you're not announcing and then, issues come up a month later that actually.
So basically, when you feel confident that the project specific risks are taken care of.
Yeah, I think that's exactly right. That's this kind of the probably a guiding principle. So one, the size, scale, materiality, as well as feeling that we've sufficiently due diligenced and so on. Now, the fact of the matter is that we have another principle that we have when it comes to sort of, let's say, de-risking kind of future execution. We have multiple sites, and we do, and the way that we build and the way that our stack is designed, it gives us a degree of flexibility in terms of where capacity can be deployed from, and where clients can be serviced from to some degree. And so we do want to be in a situation where we're not overly dependent on one specific sort of site or one specific timeline. But the bigger we go, the easier that is to sort of deliver.
Yeah.
But the principle, in terms of coming back to the main question at the beginning, is uh, material and high degree of sort of confidence that we've reached that sort of that critical stage of having sort of de-risked and due diligence at the outset, and then we then are more comfortable announcing.
Yeah, investors in Nebius have all kind of noted by now that your communication philosophy. So maybe this is something where you are very influential. Maybe you're in the source of that. Actually, no, it has been the history of Yandex as well. So I assume this is kind of something that you and RK probably agree, is that you generally have a pattern of not promising like very conservatively, because your guidance has always been actually very aggressive. But so far, the pattern has been very clear of under promise and over deliver, contrary to many other companies who over promise, dilute, under deliver. How do you think about that? Is it that basically your guidance is usually kind of what you think is realistic, then until secretly Arcady lights a fire up under everybody's ass and like, okay guys, double that, go, 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 go? Or is like how do you think about guiding and meeting expectations? Because obviously the markets don't price in what you say, they price in what they expect. So the downside of that, to be honest, of course, is that if you say 7 to 9 billion ARR, I think 10. Does that make sense? Like it's obviously very difficult.
Yeah, no, I think that we try to be as grounded and realistic as we can be. When we're coming up with guidance based on what we can see now. Now, the fact is, we think we perform very well as a company. There is a bit of a culture of kind of nothing's impossible and so on. But no, our numbers are our best estimate as where we see things landing, and based on what we can see in terms of commitments or otherwise. So there's no let's just say this and wink wink.
There's no sandbagging.
I mean, we do the best that we can in a rapidly evolving environment to give a sense as to where things are going. So it's a best effort based on what we can see happening, and we try to be as grounded as we can.
Okay, let's come to the last two questions. Probably more fun ones, less grilling. How do you think investors should value Nebius when it comes to the valuation framework? So, for example, my personal view is they should absolutely use an ARR multiple. I mean, you give guidance in ARR. I think an ARR multiple makes no sense because it's the only metric that makes sense to me. Obviously, there's a lot of metrics like profitability, gross margins, CapEx, but like if you want to simplify it, I think people should focus on ARR because obviously you're still investing very, very aggressively. A PE multiple doesn't really make sense before you're profitable. Obviously, EV to EBITDA, same. Looking at yearly revenue does not really make sense if revenue ramps like this throughout the year. So like, honestly, I'm really, really confused when people use a price to sales multiple or EV to EBITDA for a company that's in hyper growth. I feel like it's, to be honest, I feel like it's people that should not be growth investors, because obviously you should look at like the path you're going, and ARR is the only metric that I feel like is taking into account where the business is right now. I mean, if you're growing revenue 700% year over year, why would I take in the Q1 revenue? Like, so how do you think about this? And maybe one more bit of context is that somebody from the Nebius team told me a lot of the this was like half a year ago, so maybe this is outdated by now. But somebody from the Nebius team told me that a lot of the analysts covering Nebius come from telecom infrastructure. So these are not hyper growth analysts. And a lot of them still put or have put Nebius into like the physical world infrastructure bucket, and they're not used to like the AI growth rate, 600% year over year. Like, it's obviously crazy. How do you think about that?
Well, I do think that, up until now, there's been a lot of focus on ARR, and that's correct, as for the reasons that you say. It's the best mark of the trajectory, because at the end of the day, people are probably putting more into what they think we're going to be achieving and delivering in a year's time rather than a quarter's time or 2 years' time, and so on. So I think that, it's correct that, first of all, ARR has been a key metric that we have been sort of guiding on and reporting on, and we think there's a lot of logic to that. But it's not just ARR, and I think that there is, people's view of potential levels of profitability and margins are also are also very important here. So I think that again, the market, I think, broadly looks at that, so what's the trajectory of the revenue growth, but also what are the likely margins around that, and you put the two together, and I think that ultimately then kind of forms a sort of an important part of people's view around valuation and so on. So I do think that our focus on margins and focus on building a business that's going to be able to deliver healthy margins is a very important component, as well as the pure revenue growth trajectory.
All right, Tom, thank you so much for all these great insights. I have one last closing question. 12 months from now, what would be like your dream headline? If you can now, you can write a little headline about Nebius, what will happen. What would be like that? This is a weird way of saying it, but like, what's like the headline of your dreams? Like, what's the best thing that could happen within 12 months that you would love to read?
It's a great question. And I don't know if I have the exact headline, but I think the headline is enterprise adoption is real and fast, and Nebius is winning in the enterprise. I mean, that's ultimately what we need to do over the next year. Enterprise adoption, we're at the beginning of the beginning of this journey. We're at the tip of the iceberg. Many of us assume that this is going to be significant, and that the rate of growth is going to be very, is going to be many multiples of, of what we've seen so far, and that we're at the beginning of an exciting journey. And we, Nebius, are building for that. And so our assumption is that we have an ability to really build a platform, to build a kind of an offering, build an experience that's going to really win in the enterprise space. And so I think in a year's time, the adoption is happening and Nebius is winning. That's what we want to be able to see, and it's what we're going to be laser focused on and delivering in the next year plus.
Awesome. Yeah, I believe we're going to read it, and thank you again so much for taking the time for sharing all these insights. I don't think this is normal. I really appreciate like how transparent the Nebius team management is, and gives us insights from all these angles, all these insights. It's very valuable to many investors. And I hope we can do this again in the future.
It's a pleasure to speak, and we'll be in touch.